PayPal stock, the fintech giant, is down roughly 12% as I am recording this episode after the company reported earnings. Unfortunately, it seems like earnings did not meet expectations for most investors, but maybe I am overlooking something. To me, earnings weren't horrible, and I do believe this 12% drop is a little bit of an overreaction. In today's episode, what I want to do is the following. I want to first take a closer look at their earnings call and kind of go over any commentary that I found pretty useful. Then obviously a quick overview on their earnings, and then just kind of end up with my overall thoughts on PayPal as a company and what's it doing in my portfolio. So let's get started with today's episode. So as we can see, PayPal is down roughly 12%. And I want to say, I don't know why, but I believe the earnings weren't horrible. I didn't even think they were bad. I don't think they deserve a 12% drop. Right now, we are PayPal obviously is in the fintech space. And there's numerous headwinds in this market, especially for PayPal, who depends a lot on transactions. So while the overall kind of macroeconomics is creating a massive headwind, I personally didn't expect much growth from PayPal in forms of revenue or anything else. What I was really interesting in my overall investment thesis, and obviously for every investor, this thesis could be different, is how are they doing in their unbranded products? How are they doing in their digital wallet products? How are they doing in their core branded products? And overall, things seem to look okay. So that is why I'm a little bit confused of why the stock dropped a bit. Obviously, we did see a bit of gross margin or a bit of margin depreciation, and we'll talk a little bit about that later on. But overall, to me, PayPal responded. PayPal's earnings were as expected. So let's start off with the overall commentary. So I do like how the CEO started off pretty much the earnings call by saying that the number one job in PayPal is to invest and innovate to improve their value propositions to their merchants and consumers. I believe when I sometimes talk about PayPal as a stock, many people are saying, hey, this is probably like the next AOL, the next kind of old big player, the next IBM that's going to get taken over by some other new player. And that tends to be true if a company does not seem to be innovating or focusing in their core products. And I do believe PayPal at the moment is doing that. Obviously, if things change, then maybe I might change my overall thesis. But at the moment, I personally believe that they are innovating and are improving their core products. For those unfamiliar with their core products or their main strategy, luckily the CEO did give that to us. They say that their three strategic priority remain consistent. First, improve their core checkout proposition, their core PayPal brand. Second is grow their unbranded processing. This is thanks to their Braintree solutions and also their PayPal complete payment solutions, which is recently a new growth opportunity for this company, in my opinion. And finally, drive adoption of their digital wallet with Venmo and increasing their Venmo solutions and obviously their PayPal solutions. So overall, those are their three main products. I believe in this earnings, they continue to show that this is what they're focusing on. On some great news, they also mentioned that their PSP, I do believe that's payment service platform offering across their unbranded and other merchant services, is growing faster than the market and they are taking share. I think that's great news, right? Because PayPal is a behemoth in this space, and for them to be grabbing market share, especially during these macroeconomic times, in my opinion, is very, very impressive. They also mentioned that there are 4 points they want to make regarding their unbranded momentum, and I believe the unbranded momentum is the true driver for future revenue growth for this company. Like I mentioned, this is their Braintree solution and their PayPal complete payments platform. So first, they mentioned that unbranded processing is a strategic imperative for them. And this is where I believe PayPal made the right choice. I believe that if PayPal did not go on with their unbranded solutions, then this probably could have been the next IBM, could have probably been the next AOL. But with them focusing on unbranded solutions and kind of just pushing other solutions outside of their branded process, it kind of gave them the opportunity, and I believe this opportunity will do well for me if it continues to do well for them, for my investments. So they do mention going forward, they will primarily focus on enabling unbranded processing and their latest branded checkout experience through Braintree and PayPal Complete Payments. Second, they will continue to invest to help ensure their unbranded platforms are best in class, enabling merchants to reduce fraud and increase their sell conversions. Third, they are focused on substantially improving margin structures for their unbranded process business. They mentioned that their new PayPal complete payment platform opens a new 750 billion total addressable market in the small and mid-sized business market with significantly enhanced margin structure compared with their largest enterprise customers. Their Braintree and PayPal complete payment platforms, say that fast 5 times, are also expanding overseas where they can drive higher margins. And finally, the fourth thing that they wanted to talk about is obviously AI. And this might be a little bit weird to some because you might be like, Jose, how is AI such an important thing for PayPal? Well, they do mention that they are enabling merchants with their unbranded services will provide a constant stream of incremental data to feed their AI engines and fuel their next generation checkout platform. So I really enjoy this, right? Because I feel like everybody's saying, hey, look, AI is the future. AI is the future. We're doing this and that to make sure we're ahead of the curve. And these are some of the new solutions that we have. PayPal, on the other hand, they said, hey, we don't really know exactly where we're going to go with this generative AI or with this AI at the moment, but we do know one thing. One thing that's super important for having the best AI platform, the best AI models is data. And we have tons and tons of data. They obviously wanted to flex a little bit. They did mention that they continue to win and expand services with new marquee customers like Live Nation, Bookings, and Adobe. So overall, great news. They also mentioned that Venmo continues to grow its revenue by double digits, and they are pleased to see it with its total payment volume accelerate 550 basis points from quarter four to $63 billion. I do want to say quarter four is the time of holiday season. So for them to see a nice acceleration quarter over quarter, in my opinion, is great news. Now, this is another one that excites me. They do mention that later this year, they would add the ability for a Venmo user to pay a PayPal user and vice versa. I think this is going to be a great win as well, as they do have two of the big digital wallet players out there, and now those two big digital wallets will be able to talk amongst each other. I think that's going to be a great kind of one of the best things that you want to do as a consumer or as a company is reduce the friction for your customers to kind of interact with other applications. When those restrictions or that friction is loosened, I do believe it increases the overall user experience, and this is going to be one of those ways. So now that we took a closer look at the commentary, I want to take a closer look at some of those financial numbers. But first, if you want to support the channel, there's 3 ways you can support the channel. First is by hitting that subscribe button, that thumbs up. It definitely helps out a lot. Second, if you want to learn more about the semiconductor market, I do have a semiconductor membership. Just click the join button below.
Finally, I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, next, let's take a closer look at their highlights. We can see quarter one revenue was $7.04 billion. It did grow roughly 8.6%. Free cash flow was roughly $1 billion. A total of roughly 20% of revenue, again, which is great news. And then we have returned of $1.4 billion to stockholders through share repurchase. This is a company positive free cash flow, returning to shareholders, and still growing revenue during these kind of crazy times in the market. Next, let's take a closer look at some other metrics. Transactions, 5.8 billion, up 13% year over year. Transactions per active accounts, 53.1, up 13% year over year. Total payment volume up to 355 billion, up 10% year over year. And overall, we can see some charts as well here that really kind of dictate how the company is doing overall. And I think this is what's really scaring investors, right? Total payment volume, even though it is up year over year, it's pretty much flat for the past few quarters. Not much growth here. Again, I do want to say there have been a lot of pushback from overall macroeconomic events, where again, it doesn't scare me that it's not growing by much. The small decrease quarter over quarter, remember, quarter four is more the holiday season, so it is as expected. Overall, what I am liking is this: transactions and engagement. So transactions per active accounts is growing, up 13% year over year. It's even up quarter over quarter. Their active accounts did grow only 1% year over year. So again, it kind of a mixture of slowness, but a little bit of growth here. And I do believe when we start to see more of macroeconomics easing, this is a company that can grow both in total transactions per active users, in number of transactions, and overall active accounts as well. They did give guidance for quarter two. They expect another about 7.5 to 8% revenue growth. Again, nothing too crazy. They do expect non-GAAP earnings per share growth to be roughly 24 to 26%, as they are making some improvements, and obviously maybe things like layoffs, which are going to help this overall increase their margins in non-GAAP earnings per share. Now, some other metrics that I want to see: this company has plenty of balance in their or cash in their balance sheet, roughly 15.3 in cash equivalents, and investments, and only about $11 billion in debt. So more positive there. Next, I just want to take a closer look at net revenues by types. Again, this is a company that really depends on transactions. Unfortunately, that is down 5% quarter over quarter, but it is up 6% year over year. Remember, last quarter was a lot more heavier due to kind of the holiday seasons. US net revenues is down quarter over quarter 3%, but it is up 13% year over year. Unfortunately, the international market, which is roughly, I want to say 2/3, a little bit, at least 1/3, a little bit more than 1/3 of total revenue, is the one kind of lagging. Quarter over quarter is down 6%, and year over year is only up 3%. So we can see this is where a lot of the headwinds is coming along. Once we start to see that macroeconomic easing, the international market will obviously be a nice tailwind for this company as well. One thing that we are seeing is transaction margins. They are kind of lagging a bit. 47.1, it dropped down for 49.7 a quarter ago, and 51% and 50.9% a year ago. For those not familiar, transaction margins is net revenue less transaction expenses and transaction and credit losses divided by net revenue. Obviously, they do mention that there's probably a little bit more expenses with their unbranded platform, and that's where we're seeing a little bit smaller hit on transaction margin. But still, 47.1 transaction margins, in my opinion, is still pretty darn impressive. Finally, I just want to take a closer look at valuations. I mean, if looking at both forward and current EV to EBITDA ratio, again, this doesn't necessarily mean it's undervalued. I just like to see how it's corresponding to historical averages for this company. And right now, compared to its historical average, it's definitely sitting at a cheap price when we're looking in the past 3 years. I'm pretty sure, yes, even in the past 5 years, it's still pretty cheap, and that's kind of eliminating a lot of that over valuation that we saw maybe in 2020, 2021, and 2020 and early 2022, right? So to me, this is definitely sitting at a very attractive price. I do believe there's a lot of growth opportunity here, but it does seem like investors don't think that's the case. So overall, based on valuation and based on the growth opportunities, I really do enjoy PayPal right now. It is in my portfolio, and at these prices, I do believe there's plenty of opportunity. Obviously, there's risk that we talked about earlier on in this episode, but overall, I think PayPal is great for me as a dollar cost averaging over the next few weeks, over the next few months, and kind of increase my position after this 12% drop. So I personally believe it is an overreaction. Let me know what your thoughts are in the comments below. Do you think it's an overreaction, or do you think this is purely a value trap at the moment?